Nikhil, welcome back to Paisa Vaisa, and this time in the studio. We recorded, man, your episode played in December 2021, but that was online. So thank you so much for for dropping over out here.
No, thanks for having me over. It's a pleasure to do this in person.
Yeah?
Very, very different experience than chatting online.
I look really bad. I know that. Thanks for saying that. Okay, so for our first-time listeners, who probably haven't heard the episodes, and by the way, folks, please do listen to the episodes. For those who are Club Paisa Vaisa members, the archives are completely accessible. What does GRIP do?
Sure. May I take a step back and say why we started, and then we can solve for what we do. Our view was that whatever you may invest in, whatever your preferences are, diversification is a very important theme. I don't think there will be any investor globally who will say don't diversify. Our view was that most Indian investors do not have the option to diversify because of limited products, especially at a smaller ticket size. And the reason we started the company was to offer regulated, predominantly fixed income products for people to create that better, healthier portfolio. With that mission in mind, GRIP today offers 5 different products on our platform, which allow users to invest anywhere between 10,000 rupees to a lakh of rupees and begin the investment journey on the alternative side. Like I mentioned, these are predominantly fixed income products, and GRIP is responsible for curating and providing products that are probably not available anywhere else for investors to participate.
Yeah, I want to get into the structure here because, one thing that I always like to clarify with my guests is what exactly are you in terms of regulatory overview? Are you, a research advisory, or are you a fund manager, or are you a platform, whatever? So can we just get that out of the way?
We are a platform, and recently SEBI came out with regulations called the Online Bond Trading Platform License, which also allows us to apply for a stockbroker in the debt segment license to offer certain listed rated products. We have now applied for that license and in the process of obtaining it as per the process. At the same time, we are a platform for other SEBI regulated products, including those through an AIF or other listed products. And hence the entity exists as a platform in the process of applying for a stockbroker license.
Yeah. And what are your typical products? I just realized I didn't ask you that. Maybe our listeners are, someone who's not heard this from the December 2021 episode. Typically, what are your products?
I'll take 3 examples of our most common products. The first one is a corporate bond. The companies like, say, Navi, 5-Star, Muthoot, who are raising money through listed rated NCDs, and we allow investors to participate. These are typically available at a 10,000 rupees ticket size, right? And to participate, they're listed and rated, hence they're held in your demat account. The second product that is very common on our platform is commercial real estate, where investors can purchase part of a commercial real estate, which is an office building or a warehouse, and again own it at as little as 1 lakh rupees. Once again, structured through a SEBI regulated instrument. The third product, which is really our mainstay, and which is probably why GRIP is best known, is a lease finance based product. I'll give an example. Let's say you lease a car to a company and you earn rental on it. That is called lease financing. That's a fixed income product that most of our users like to participate in because it gives them an asset backing with monthly returns. That's the third product we offer, and on our platform it comes under the branding LeaseX.
Okay, so there was one question that I remember asking you back then, because when I land up on your app or on your website, you give rates of returns, okay? Because lease financing has a certain rate of return, and you know what debt is. Debt is a little bit more complicated than equity. You put a sticker rate out there, people have certain thoughts in their head. I like the fact that you use the word IRR. In all your products, I believe you say IRR, which is fundamentally different than rate of return. I mean, India is predominantly a FD country, right? So when it says 7%, 7% is stuck out there.
Yeah.
You say IRR.
That's
okay,
right.
And we spoke about this in our previous episode.
Yes.
I want to revisit that. Just tell us how IRRs work, and in the spectrum of rates of return, where is this? What does it mean?
Yeah. Let's talk about why rate of return became popular. Most people, when they think about debt, they think about that I will put money on day 1 today, and then after 1 year, I will receive my principal and return back. Right? It's what is called a bullet repayment structure. However, a lot of financial investment products on the debt side actually give you monthly returns. And that means that your cash flows don't come in a bullet, but come over a period of time. financially, the best way to measure these timely returns or multiple returns is through a concept called IRR. It puts a value of time to a return, where 100 rupees received today is more valuable than 100 rupees received after a week's time, value of time. The IRR measures that concept, right? Because our returns are all given on a monthly or quarterly basis, IRR became a better measure to tell our investors on how to look into this. I can tell you it's one of the most difficult, it's been one of the most difficult parts of building Grip to explain what IRR is and to prevent any kind of misunderstanding about it. IRR is not the same as CAGR, is not the same as rate of return, and we're trying to do a lot to educate investors about it. I think there's still more to go because, as you mentioned, it's not a very commonly used term.
Yeah, I don't know the formula, man. I just go into Excel and do equal to X IRR and time range and date range.
I think that's the biggest challenge. It's not something that you can do on a pen and paper.
Yeah.
You require an Excel sheet to be able to do it easily.
Yeah.
Otherwise, it does take a bit of time.
Let's try this now. Let's just try and generally differentiate between an FD rate of interest.
Yeah.
Okay. A CAGR, okay, which is very easily one of the best examples of CAGR that I know is stock price.
Sure.
Okay, so and so stock price went up from X to Y, and therefore over a period of time, that's CAGR. Let's look at it from that, and that's a very simplistic level. No need to get into major details and all that. But first, let's start with rate of return. On an FD, what is that?
Got it. Let's use a 1 year time frame for all of this. Makes
Perfect,
calculation
lovely.
super easy.
Yeah.
If you invest 100 rupees today in an FD and you get 7 rupees back as interest at the end of 1 year, so 100 plus 7, 107, your rate of return is 7%.
Correct.
Right? Which also is your CAGR.
Yeah.
Right? 7% CAGR. In that 1 year time frame, your IRR is also 7%. So all three numbers will match because you had a single payment and a single return. Now let's start complicating things.
Yeah.
If you receive that 7 rupees instead, say 85 paisa every month over the period of time, and then 100 rupees back at the end of the tenure, your CAGR is still the 7, your return is also 7, but your IRR is more than 7.
Okay.
Right?
Okay.
Because you received the money earlier and not at the end.
Yeah.
If we continue to use CAGR or ROI, there would be no differentiation between the two cases that we spoke about. But the reality is the second case is much better for an investor because he's getting the money every single month. He can reinvest it, he can use it, and his risk is reducing, which is the power of using the IRR concept.
Yeah, that's lovely, folks. And you'll find this in debt a lot. Like debt mutual funds also have a lot of this. Just Google this out. It's very interesting stuff. And the way that I like to learn about it is always an Excel file. Just go into Excel and figure that out. Okay, Nikhil, what's been happening at Grip since we last spoke? We last spoke in December 2021. Here we are in March 2023. The episode will play in April. A lot has been happening.
Yeah.
Let's talk about that.
Yeah, maybe start with the top level numbers, which I think is a great indication of where this industry is going, not just Grip is going. I think when we spoke in December 21, our business was maybe around 50-60 CR of business. We're proud to say today that we have enabled about 650 crores of investments through the platform. We're doing about 50 crores of investments or enabling 50 crores of investments every month through the business. We've seen a similar scale up even in terms of the number of users on our platform. And I believe that this is an indication of where alternative investments as an industry is going. Most people believe, and just to this point, most people believe that alternatives for individual investors, platform-based is a small industry. But in the last 12 months, over $1 billion has been invested in this industry across platforms. So I think scale has fundamentally changed across our businesses. I think the second big thing that has happened is a move to a much more regulated structure. And I would give incredible credit to the work that SEBI has done in this. They came out with a discussion paper last year to think about how to offer more fixed income products to retail investors. They understood that was a need, and on the basis of a discussion paper also came out with regulation. I'd like to highlight a few key changes that happened there. Number one, they reduced the minimum ticket size for privately placed bonds by 90%. That's huge. What was earlier available at a minimum ticket size of 10 lakhs is now available at 1 lakh rupees.
Privately placed bonds.
Privately placed listed rated bonds is now 1 lakh rupees.
Okay.
I think that's a massive forward step by SEBI in understanding that this is a market need. At the same time, they made it mandatory that it must be a listed and rated bond, which ensured that there was a certain amount of KYC diligence that was followed, right? So you had a certain curation that was established. SEBI's also instructed the stock exchanges to accept UPI as a payment, right? Making it really more accessible for people to do it. So I think that's the second big change. And we've been able to change alongside that regulatory direction, both in letter and spirit, to say we must only offer SEBI regulated paper, ideally listed and rated, right? And that's the direction that the SEBI chairwoman sort of outlined. And then the third big change at our business has been a very, very heavy investment on the tech side. Our view is that the user, and Anupam, we did some user surveys. We were sort of shocked by the results. We asked our users whether they would prefer a DIY approach, do-it-yourself approach, or would they like an advisor to invest. 78% people said they'd like a DIY approach.
Wow.
Less than 20% people said they'd like to have a advisor. 90% people said that they do their own research. Less than 20% said they relies on an advisor. Some people rely on family. But increasingly, we're seeing that for that age group of 30 to 40 people, white-collared, there is an increasing desire to take control of their money. They are curious, inquisitive to learn about new investments, and then receive all the information transparently to make an investment decision. There does exist a little bit of distrust or mistrust on relationship managers, advisors, because they see a conflict of interest, and hence people are preferring this approach. On the back of this, the third big change has been to double down on the product and offer a fantastic do-it-yourself, super transparent investment experience.
I find it very interesting, Nikhil, because here we are. Is Silicon Valley Bank is gone, crypto's having its own problems, SBF, as we know, was another thing altogether. So, trust and technology, and since you mentioned that you're putting a lot into technology, it's just that probably I belong to some other generation. I'm not sure whether
we can all say that we have a advisor, but I think the question is important. Why is Roboadvisory becoming interesting, right? Because there is access to information, there's access to being able to analyze that information, and in a cheaper and more powerful format than ever before. Today, a user has access to ChatGPT 4 at $20, the same computing power that an institution would have access to, right? And hence, in that world where information is so democratized and these tools are so democratized, I think you're saying, what is my quality of advisor? And how can he take more control or give me more value add to the information that I already have? We work with a lot of advisors, right? I think it's the question about quality and how do you make sure that that's the right one in place. Linking it to the user, right? We typically see users who's, I would say, are working in IT services, legal, financial services, or early stage companies. The top metros and tier 1 cities account for about 60% of our total user base. 40% comes from tier 2 and NRIs, right? And these are people who would have income levels over 15 lakh rupees. I've said this many times. GRIP is not your first investment product, right? Your first investment product should be your FD, should be mutual funds. And then as you think about diversifying, please come to platforms like GRIP to look at options. Begin with options like corporate bonds, which are listed, rated. They're A-rated corporate bonds. And then begin your journey of diversifying into alternatives. But that's the cohort of people that we believe should look at alternatives. Sure.
Just tell us about the range of products that you've got. You said you've got bonds. I know that you've got SDs. Let's talk about that for a bit.
Got it. The philosophy is to offer a range of products by yield and tenure, right? Wherever you think you fit, your risk reward fits, you should be able to have a product. Our lowest yield is 8.5%. Our highest yield is 16%. Our lowest tenure is 1 month. Our highest tenure is 60 months. So wherever you see yourself on that spectrum, you should be able to have a product at GRIP. We today offer products like corporate bonds, inventory financing, leasing, commercial real estate, and for people who are looking for a slightly more higher level of risk, early stage startup equity.
Early stage startup equity, how does that work? I mean, do you have certain deals that are specific to you and you offer that and I sign up? I mean, and this is equity, right?
This is equity. This is unlisted startup equity.
But it's still a secondary sale. So you'll have like an XYZ or someone who's there, someone from there is selling their shares, and you offer, you kind of can patch that
It's
in.
both primary and secondary. So
Nice.
the way we've done it, and I think we've approached it interestingly, is there are lots of companies who we lease to or provide inventory finance to, and these companies also raise equity capital.
Got it, yeah.
Whenever they raise a round, which is led by a VC, and this is very important, it cannot be a round that we have constructed on our own. This must be a high quality VC who's writing a significant $1 million, $2 million, $10 million check. Can our users also participate at the same terms alongside this VC? You may not have the $1 million it requires to be to invest in the VC, but can you participate along with him? Those are the opportunities that we can create as a startup equity, again through a SEBI regulated structure.
Yeah, and I noticed that you went for yield this time and not IRR. So is there any difference out there when you mentioned that there's 1 month or whatever?
Just the learning that it's maybe easier from our context, from cultural context, to understand yield. But that's the sort of range of yield that we offer. It just allows people to understand better. But yes.
Yeah. Can you give us some examples of each of the buckets? I mean, each of the categories that you spoke about.
Sure.
You spoke about the equity part, but what does the 1 month product look like, or what does the Lease X look like? What does the inventory finance look like?
Sure. So, for example, a corporate bond, Navi as an NBFC issues corporate bonds. It's if I remember correctly, an A+ or A rated paper, and that's an example of a corporate bond. Inventory finance would be to, for example, a company, a footwear brand has shoe inventory and wants to raise finance against that inventory. You give it for 1 month, they will sell it and give you money back. LeaseX, and probably our most interesting transaction till now, we have leased ATMs to a company, ATM machines, and against that the rental payment is the investment you're making. So you're very secure because the payment is ultimately coming from a bank. Commercial real estate, our recent investment was in a project called L&T Seawoods in Navi Mumbai, where you were able to invest 1 lakh to own a piece of commercial property and earn rental income against it. And maybe the last startup equity deal we did was for a company called Zip Electric. They are the largest electric vehicle fleet operator in the country, and our investors got to participate in a $20 million equity round alongside the lead investors.
Yeah, I'm if I'm a listener right now, I'm just thinking what's the default rates and what are NPAs, and has anything gone south? Have people lost money? What about that?
Well, the answer, and touch wood, is zero.
Okay.
We have a 0 NPA rate. It's been close to 30 odd months now. I'd like to believe that we are doing a very good job, or we're investing the right amount of effort, and we have a very high degree of intention to act in the interest of people in terms of curating the deals. I can't tell you that will not happen, right? But I think our efforts in that direction is to make sure that it happens as less as probable. We've been able to maintain this through a combination of credit underwriting, but also of asset management. Companies that we have worked with have shut down, have been sold to other companies, have had very difficult times. But because we've monitored them on a month-on-month basis, been able to do asset recovery, we've always been able to protect the investor and not have an NPA. I think the last step that we do is nudge investors to have more than one investment, because that allows them to build a diversified pool. And today, on an average, a GRIP user has 3 investments on the platform.
Nice. Okay, Nikhil, from the last time we spoke to today, the one thing that's very different, and it's been there in the papers also, is the SDI product that you've got. Securitized Debt Instrument. Okay, and I think you launched it when? Last year sometime?
October 22.
So LeaseX is primarily that.
Yes.
Let's talk about that. What is it?
Sure. I'll try to break down the SDI first, and then I'll talk about what kind of investment it offers. Securitization, as the word sounds, Securitized Debt Instrument. Securitization is basically when you convert any stream of future receivables into a financial product. You basically say, and Anupam, if I use an example, Nikhil's given a loan to someone. He's owed some interest payments. But what if Anupam wants to purchase those interest payments? Can I securitize and give it to you so that those interest payments come to you? That's securitization. The beauty is that it can be done for any product offering fixed returns. Our mainstay product, and we've always talked about it, is Lease Finance. We've been able to use this securitization paper to also do it for lease rentals that come on a month-on-month basis and convert that into an investment product. The SDI is a framework that has existed with SEBI since 2008. I think they were very forward-looking in creating it. Unfortunately, for a variety of reasons, it had never been utilized for creating such a product. One of the biggest milestones and something you can only hope to achieve as a founder is we were able to list the first ever SDI in this country on the National Stock Exchange on 7th October 22. And NSE was very gracious to allow us to come and ring the bell, which was a very special moment in our company's life. But since then, this has become a real mainstay product. From an investor's perspective, what this offers is monthly rentals against either a single or a pool of leased assets. Because it is regulated, it is also required to be rated. So we work very closely with CRISIL to rate each product. It is also listed on the stock exchange and hence held in your demat account. By nature of this product, the taxation is also efficient because it only applies on the interest income or the profit that you make from this instrument. And that's what LeaseX is.
So you're a platform, okay. You don't own the asset and you don't have a book, because obviously if you had a book, then you'd be regulated by the RBI. So how does the model work out? In the sense that there'll be a ZIP which is buying, maybe batteries from some guy who makes EV batteries. Okay, so you've got a buyer and you've got a seller. Explain how this works probably in this context, or any other context that you think is appropriate for our listeners to understand what's actually behind the SDI.
Perfect. Let me use the example of a company called Everest Fleet that we work with. We're very proud to be associated with them. So I'm going to use this example and credit to the journey that they have had as a founding team. Everest Fleet runs cabs on Uber's network. There is a company, which is let's call it Company X. Company X buys these cars from Maruti and leases them to Everest Fleet. Under the lease agreement, Everest Fleet is obligated to make monthly rental payments to Company X. Company X securitizes these rent payments and assigns it to a SEBI-regulated trust structure, and the trust then issues the SDI. Okay. GRIP, in this role, acts to basically enable this transaction and find the investor and do the placement. This is the sort of the nature of the transaction that happens, and the investor hence earns the rental that come out. The assignment is done to a trust structure which is completely independent from GRIP and is managed by a regulated trustee.
Okay, so if I line up, or let's say that I sign up on GRIP, download the app and finish my KYC, and I go in for this kind of a product, or the SDI. So I'm basically buying paper that belongs to Company X, if I've understood it correctly.
Technically, you're buying paper that belongs to the trust, and the trust has purchased or got this assigned from Company X. The originator is Company X.
Yeah, so the trust kind of ring fences everything in my interest.
Interest.
Tomorrow, if Company X sinks, you'll at least, and the trust will ensure that at least I get probably some money back or something.
Because this is a financial podcast, I'll get into some technical terms. This is something called a bankruptcy remote structure, where if even Company X was to go bankrupt, it has no impact on the transaction of the investor. All cash flows coming from Everest Fleet are made into an escrow account and completely delinked from the operations of Company X. So the trust has complete control on the cash flows.
Okay. So, I make my money off that product.
That's
the LeaseX product is an SDI that sits in my demat account.
Correct.
And every month I get the...
Every month.
Okay. And what are the tenures typically, and what are the, you call them yields, you call them IRRs, whatever. What would it be in this specific case?
Sure. So the tenures are about 36 months. We are looking to also do a shorter tenure, but we've currently done 36-month tenures. The IRR for this product ranges between, I would say, 12% to 16%, depending on the rating. A AA or an A-rated instrument would be 12%. A BBB instrument would be 15-16%.
Okay. And so the income for me as an SDI investor are these monthly payments.
Right.
That's my income stream that comes in. And this is taxable as normal income for me. Like
Absolutely.
If I'm let's take a profile of an IT employee, he's got a salary. This would be classified right next to my dividend income, of my FD income or whatever.
That's
get
correct.
taxed at that slab.
So every month you receive a combination of principal plus interest. It's like an EMI payment. The principal is not taxable. The interest is taxable at your normal tax rate.
Okay, great. I want to talk about the credit rating now. Okay, what is the role of credit rating out here? Is the instrument rated by CRISIL, or is company X rated by CRISIL, or are both? And how do what do those ratings mean to me as an investor?
Sure. No, great question and really important. I think one of the big changes that has happened from December 21 is also to be offer predominantly rated instruments. And as an individual investor, you're constantly thinking, how do I evaluate this, right? I think a rating helps provide some benchmark of the risk and reward in the situation. CRISIL and the rating agencies' job is to say what is the likelihood or what is the risk of the investor receiving these cash flows in whole, right? Is there likely to be, what is the risk I would assign on a default on this? As most people know, the rating scale, the best rating is a AAA rating, and anything below a BBB is not investment grade. The same scale is used for these investment opportunities, and an assignment of that rating would give a reflection of the credit agency's view on the chance of default or non-payment of returns. As you can imagine, the better the rating, the lower the returns, because the risk is lower, and that's how the pricing is done.
Okay, and typically, what are the range of credit ratings that you've seen on the deals that you managed to get for your users?
We've seen a range from BB to A+, so that's quite a bit of a wide range, and I think that's the beauty of the vision at GRIP, right? We want to offer that full spectrum, so we also offer a spectrum of ratings, BB to A+, giving you returns between 11 to 16%.
Okay, now the hairy stuff. Okay,
yeah.
What happens in case of a default? Let's say that company X, Everest took a lease or whatever 3 years from company X, and they just go down. Somebody's got to bear the loss.
Yes.
Okay, so let's look at it from that perspective. Who bears the loss? And since you said it's a trust structure, it doesn't reach my doorstep, but it has to be somewhere. So how does that work?
Yeah, I think it's very important for people to understand that as an investor, you bear the loss, right? GRIP at no point of time is guaranteeing the returns. Neither is the trustee nor is Everest Fleet, right? They're all contractual obligations, but there is no guarantee of returns. As an investor, if there is even a rupee of loss, it's on your balance sheet. There are certain things that we do to try to mitigate the loss. And, credit underwriting, CRISIL's or any rating agency's view is one, but there are other structural elements to it. The most important one is that every transaction has a security deposit, which means close to 12% of what you invested in is already received from the company as a cash deposit and held by the trust. So up to 12% of your transaction is protected on day one. Second is a hypothecation of the assets, in which case if Everest Fleet comes down, there is a ability to monetize those assets and recover value. I think the third is the monthly repayment structure, which is why that IRR concept is so important. On a yearly basis, you would receive close to 40% of your principal back in just 12 months. In 24 months, you've received nearly all your principal back. And hence the chance of default or loss of capital keeps reducing very significantly.
Yeah, so you're saying that my worst case scenario is I might lose on interest maybe for a year, but my capital is intact. So if I'm putting in a lakh, expecting, say 10,000 per year. So 10,000 worst case scenario might go up and down, but the chances of the 1 lakh getting destroyed are, you'll try your level best, and there are enough safeguards out there.
Absolutely. I would, take a little more conservative and say the worst case scenario is that you may lose up to 90% of your capital, right? Assuming the company defaults on day one. But I think there's enough, if there's a rating out there, we have done our work, we have a track record, I think you can believe that that is a very unlikely, or the probability of that event is very low. As you correctly said, the way we think about it is the safeguards built would give a high degree of protection on capital. But yes, this is a alternative investment. There is a risk to it, and investors must be prepared for
that. And it's very important, folks. Remember what Nikhil said right at the start. He said that your primary product should be an FD, then mutual funds, and then when you want to diversify, then this is the kind of stuff that you might want to look at. Baki aapke upar hai, it's your call at the end of the day. I think I'd asked you this in the first episode about what we had done, but just to revisit that, it's a hygiene question. What happens if you shut down?
Yeah, I think the beautiful part is bankruptcy remote, right? None of these structures, in terms of returns, have any dependency on GRIP. the investor is completely, like, GRIP has no role to play in ensuring these cash flows come. They're all managed by a trustee. And I think, again, to acknowledge the spirit of what SEBI's regulation is, this is exactly what allows that protection to happen. And the more and more we adopt these frameworks, SEBI comes out with new regulations, I think we will be able to protect the investor from all such scenarios in the future. Today, I can tell you confidently that if GRIP was to shut down, all the investments that have been made till now will continue as promised.
Nice. And the demat, so the instrument that I hold in my demat account, that's not going to say GRIP. That's actually going to be saying the
trust name.
What you call the trust name.
Trust name.
Okay, okay. So folks, just keep that in mind. Okay. When you go on GRIP's website or the app, you might find those IRRs or those yields out there, but we've discussed that at length. You can also revisit the older episode to get a real detailed understanding about how IRRs and yields work. Nikhil, what on a risk level of 0 being FD or whatever, GSEC level to 100, which would be like really adventurous, where do you think your investors are? I'm trying to ask this because I'm an equities person. I understand that more easily. Debt has always been too complicated for me.
Yeah.
On that risk spectrum, what is a GRIP investor?
Yeah, I want to talk about this equity debt thing for once. I keep hearing it, I keep getting this a lot as feedback.
Okay.
We as investors, we have a very different mentality towards equity and debt. We actually think that अगर equity में पैसा lose हुआ है, it's okay, right? But debt में पैसा नहीं lose होना चाहिए.
Correct.
Right?
Correct.
And we don't necessarily look at it in terms of how much money we lose and what's the returns, right? Which is the only benchmark. Ultimately, if you think of it at a base case, it's about how much money you're losing or making, irrespective of the instrument. I would believe that there are lots of times that retail investors have lost considerable amount of money on equity, right? But we rarely talk about those instances. Companies have gone public and lost money on the IPO day. There have been incidents with certain very, AAA names where people have lost money due to news events as recently as last month. And that happens all the time. And I would believe that if you're an equity investor, you're actually having a much higher appetite for risk.
Correct.
And I think that's important for us to think about how we think about both sets of instruments. If I look at purely the scale of what you asked for on a fixed income side and don't mix equity and debt, I think GRIP investors are probably in the 5 to 6 range of where they stand in the middle of the bucket. There are some really exotic fixed income products that are possible, that are out there. We don't offer those. And they're in the 5 to 6 range where there is a certain appetite for investment. Maybe the last point, Anupam, is that this also changes a little bit with your own personality, your profile, your other wealth. You could perceive GRIP to be a really safe instrument, or the investments on GRIP to be really safe because you have other financial security, right? And I think that's the important part of how you think about building a portfolio.
Nice. And last couple of questions on Nikhil. What's your take on the whole interest rate scenario? Because debt is the place to be. Equity so पूरा का पूरा मर गया, ऐसा लग नहीं रहा कि कुछ हो रहा है वहाँ पे. What's your take? What do you think? I'm going to ask this to you in two ways. One, do you think interest rates have peaked? And two, what's the kind of product that someone who just wants to play the interest rate side should be looking at right now?
I would like to believe that interest rates are near their peak. It would be difficult to believe that we have a significant more cycles of interest rate to go, both from because we're seeing inflation sort of stabilize, taper off. At the same time, I think governments are conscious about impacting growth significantly. We're seeing some of that play out in the US markets and the European markets more than we're seeing it play out in India. So I think interest rates are near their peak. Whether there'll be another 25, 50, 100 bips, difficult to call. I think given that is the expectation, and not just me, I think there are lots of people who have this, there's a great opportunity to get into bonds, right, or fixed income instruments, because once the cycle starts reversing, you have an opportunity to make great gains, right? And I think one of my colleagues was in Vietnam over the weekend, and he posted this on LinkedIn. The front page of the Vietnam paper in Ho Chi Minh City was about how bonds are great for investors. I think generally the flavor across the board is that bonds are a good investment, or fixed income is a good investment. It could be LeaseX, same rationale applies for investors at this point of time.
Yeah. Sorry. And what lies ahead for Grip? What are your future plans like?
The idea is to double down on exactly what I talked about: regulated products, improving our technology stack, and I think the third part is actually doubling down on how we work with some of the more sophisticated wealth advisors in terms of getting our products out there. We believe the LeaseX and corporate bonds and some of the other products we have that we are coming out with are really interesting and attractive from a individual investor's point of view. A lot of focus this year is going to be how do we get it out there for more people. I would like to believe that Grip has been a little bit under the radar as a brand over the last 2 years because we wanted to get the product right. And I think there's no point of beating the drum about something that is not regulated or not compliant. And the best thing that could happen to us is to be able to apply for a license. I think it's the best thing that could happen to an investment platform. I think with that behind our back, we believe that we can be a little bit more aggressive in talking about our regulated listed products and giving more chance to people to at least see it and then decide to invest.
Nice, and I wish you all the best with those plans.
Thank you so much.
Okay, Nikhil, final question. Any content that you're reading, anything you're watching, any recommendation for our listeners?
I read this really interesting book. There's a gentleman called Steve Schwarzman. He's the founder and MD of Blackstone Group. Someone who's, Blackstone as a group is truly inspirational to anyone who is building in the wealth industry, asset management industry. And I think his personal journey and I think the candidness with which he talks about the failures, the struggles in his book was, something that was really worth reading. I think what stood out, apart from the journey, what stood out from me in the book was this approach to institution building. And I think that's really important when you think about a financial services business, right? How do you bring the right people in? How do you grow your business to last 100 years? How do you think about giving back? How do you play an advisory role? And how Mr. Schwarzman played an advisory role to presidents of the US, to policymakers, to CEOs of companies. And that was one of the best books I read. It was not necessarily financial, but I think it's about building a financial giant in possibly the right way, and a lot of inspiration for the team and me at Grip to think about how we can bring some of those attributes into how we build Grip.
Fantastic. Thank you for that, Nikhil. And that is a wrap on this episode of Paisa Vaisa. My guest, Nikhil Aggarwal, founder and CEO. Nikhil, thank you so much for doing this for our listeners.
Thank you so much, Anupam, for having me.
IVM.